Good morning, students. So we are going to continue our discussion on value-added tax. I've just made a few notes here before class so that we don't forget anything that we want to discuss, ladies and gents. So we are going to start basically this morning where we finished last time, and then we're also going to look at some very typical transactions and how to record them when it comes to value-added tax. Okay, so I presume you can all hear me now. If you can just type yes or no, please. Well, if you can't hear me, you won't type anything, will you? Thank you so much. Thank you all. Thank you very much. Now, thank you. I appreciate that. So last week we spoke about value-added tax. We said that you can claim back the input tax on the supplies made to you by your various suppliers, and that can be suppliers of goods or services. We mentioned that, so that includes your inventory, your electricity services, your telephone services, your internet services. So uh, uh, any goods or services that were supplied to you. But then, on the other hand, you have the obligation to then raise value added tax on the supplies that you make to your customers. Now, the first little item I just want to discuss here, and I'd like you to participate, please. Now, it's called value added tax, and the act is actually called the Value Added Tax Act. Now, uh, you've seen the way that we can claim the input VAT last week and the way that we have to raise the output tax. Also, we discussed that last week. So really, ladies and gentlemen, if you think about that, because you as a business, because you are able to claim back the input tax and you have to raise the output tax, and you only pay over the difference between the two to the revenue service, it means it is really a tax on value added. So the value that is being added within your business, that is the tax that you are actually going to be paying over. So let's think about two possibilities, ladies and gentlemen. Two would be enough. How can a business add value to the goods and services that it has received or procured? If you can type perhaps a few thoughts for me there. What do you think? How can a business add value to the services or the goods that they've received from their suppliers? How can they make it worth more? Markup. Thank you, Keegan. That is a very, very good answer. The markup, ladies and gentlemen. You know all about markups from inventory. We're going to discuss it again later today when we bring inventory and markups together with the principles of value added tax. So in effect, the profit that the business adds to the goods and services that they've received means automatically that their selling price is going to be more. And because of that, they have added value. Perhaps one other possibility that I can mention here, it is not such an obvious one. If this had been a manufacturing business, if they actually manufacture a product, then they will be procuring or purchasing raw materials, and they will add all sorts of things to that. In other words, they will perhaps use 3 or 4 or 5 different raw materials, combine them into a product. They'll add their labor. You'll learn all about this in cost and management accounting. So they will have staff and they will have people who are going to be employed in manufacturing this item. So they are actually converting a various combination of raw materials into a completely new product. Right. So again, during that process of converting various raw materials, adding labor, adding other costs such as depreciation and so forth, which we call overheads in cost and management accounting. during that process, they are adding value. So that all has the effect at the end of the day of increasing the selling price more than your original purchase price. So during that process that you are converting or manufacturing a product, as well as Keegan said, adding your business's own profit, you are adding value. And effectively, it is on that value that you have added within your business that the value added tax will be paid over. You understand that the suppliers, your various suppliers, they've already paid over the output tax on their side. So whatever value they have added has already been paid over, right? That is why we are able to deduct the input VAT. So in effect, we are paying over to the revenue service value added tax on the value that has been added within our business. Happy with that? Does that make sense? Hopefully. Then just to refresh our memories about what we spoke about last week, VAT on acquisitions, and that is not necessarily only goods. That could be goods or services. That is going to be part of the consideration that you are going to be paying over to the supplier. But that value added tax that's included in there, which we refer to as our input tax, you can claim back, right? And we spoke about this. There was a question last week. Why do we call it input tax or input VAT? It is because it is the value added tax that we pay over to the supplier on goods that we are putting into our business. The value added tax on our supplies, in other words, goods or services that we are rendering, that is going to be paid by our customer to us. So that is going to be included in the consideration that they are going to pay to us. So when we receive money from them, it will be the amount that belongs to us, which we will set as a factor of 100, and it will be the output VAT, which has a factor of 15 or 15% then, that does not belong to us, that belongs to the revenue service. And then our output tax less the input VAT, output VAT less input VAT is the amount that we have to pay over when we submit our VAT 201 return. Now let's just look at a typical example. I've got to emphasize here, ladies and gentlemen, that I've used purchases here as an example. But remember, any taxable supply made to you will carry value added tax. And if it is not one of those items that are prohibited, where you are prohibited from claiming the input tax back, then you are allowed to. Something like entertainment cost. Remember, we spoke about entertainment cost the other day, including staff refreshments, because it can be abused. It's easily to be abused. So if you are the owner of a business, if you are able to claim your input tax on entertainment and groceries and staff welfare, such as lunches, then you might be tempted to buy your own household goods through the business and claim the value added tax back, right? And that is obviously not allowed. So to prevent that, the Revenue Service has decided that all entertainment expenses you are not allowed to claim the input tax back. But in any case where it is allowed, it means you can, right? Okay, so in this case, we say the consideration for the purchase, in other words, the VAT inclusive amount. If you want to make a little note there, I think most of you would have done that last week already. When we speak about the consideration, it means it is the inclusive amount. It is the amount belonging to you plus the amount belonging to the Revenue Service, right? So how are we now going to account for this? So we have to record the acquisition of the inventory, right? Ladies and gentlemen, let us assume that we are using the perpetual inventory system. That means we are going to debit inventory with the amount exclusive of that. Why exclusive of that? Maybe someone can just type a little sentence for me there. Why exclusive of that? Why do we only put a value or a cost on the inventory exclusive of that? or someone can maybe speak up if you don't mind and tell us why are we excluding the VAT from the cost if we are a registered vendor. Simunye, I'm not exactly sure what you mean by DE, exempted tax. Well, the crux here, also with CISO, thank you, there is a VAT account. The crux here is that because you are able to claim the input VAT back, it is not a cost to the company or to the business whatsoever. That is the important thing to realize, ladies and gentlemen. You are paying that 15 rands over to the supplier, but at the end of your VAT period, no problem, no problem. I always, that's no problem, Simunia. Um, uh, because you can claim it back, it means it is not a cost to the business, right? So therefore, the only cost to the business is the 100 rands. You can make out an argument that temporarily, the 15 rands or the 15% is a cost to the company, but it is only for the 2 months period until you submit your VAT 201 return. Then you claim it back. So by the so the fact remains that you'll have to keep those two separate. So therefore, we are going to be debiting inventory with the amount exclusive of that. How do we get the 100 again? I said I'm going to mention Angel's name a few times today, probably. Angel has a wonderful little formula for us. How do we calculate it? What we want over what we have. Okay, what do we want? We want the 100. Here we go. Thank you, Angel. What I what I want over what I have. Right. So what do we have? We have the consideration of 115. What do we want? We want to calculate the factor of 100. So we take the 100 over 115 multiplied by 115 rands. Okay, these figures are now very straightforward. So it works out at exactly 100 rands. Right. So we're going to debit our inventory account with that 100 rands, exclusive of that. But we are going to have to pay it over to our supplier, so therefore we have to raise the full amount payable to the supplier, right? So we are going to credit accounts payable or creditors if you wish, or creditors control with a full 115 because we have to pay the full consideration to the supplier, which means we've got a debit of 100 and a credit of 115. And as you know, we cannot tolerate a journal entry that does not balance. So we have to have another debit of 15 rands to make this journal entry balance. And that represents the input VAT, ladies and gentlemen, that we are going to accumulate on all transactions, on all our acquisitions. We're going to accumulate it, and at the end of our VAT period of 2 months, we are going to add them all together, and that is going to be the input VAT that we claim back from the revenue service. Okay, so that is a typical acquisition or where we've received a service. That is how we're going to account for it. If that had been, let's say, our MWeb internet account, right? For that same consideration, what would we have done? Then we would have debited not inventory, but let's say internet services expense. Right, internet expense or internet services expense. We would still debit that input and we would still credit accounts payable. Now, ladies and gentlemen, let us look at this one. I'm not displaying the answer yet. I want you to give it to me. We now have a sale. Let's say we make a sale to one of our customers, right? The total consideration for the sale is 230 rands. So, ladies and gentlemen, let's start. Let's start maybe with the easy one. Which account or accounts are we going to credit? There are two. Which account or in this case accounts, are we going to credit on this sale? You are allowed to be brave. VAT output, thank you, Mr. JT. Thank you, Lucille. That's the other one, sales. Prince, yes, there's also the matter of your trading stock and the cost of sales, but let us maybe just now focus on the sale part, not the cost of sale. Just the sell part, as many of you have said there, you are going to credit. Leto also says there, sales and output VAT. Those are the two accounts that you are going to credit. Which account are you going to debit if this is a credit transaction? So you're not selling it for cash, you're selling it for on credit. Which account will you debit? Debtors control or accounts receivable. Thank you so much, ladies and gents. You are 100% spot on. So we are going to debit, depending on what we call our account, accounts receivable or our debtors control account. Now, ladies and gentlemen, let's quantify this. Let's quantify this. With how much are we going to debit our debtors control or accounts receivables? With how much? Baltimore, I think you just made a little typing error there, but you've got the idea correct. Yes, Baltimore, that's correct. Yes, Caleb. Yes, Buyukatsi. Okay, so with the full consideration, remember that that customer of ours must pay us the full amount. Otherwise, we cannot pay over the value added tax, the output tax. So they must pay us the full consideration. So therefore, we're going to debit our debtors or accounts receivable with 230 rands. Okay, ladies and gentlemen, with how much are we going to credit output VAT? Let's do that one first. With how much are we going to credit the account output VAT or VAT output? There we go. Thank you, Lucille. Thank you, Ndabeni, Vuyukatsi. Oh, Alizwa, too many to mention now. Thank you. How did you get that? Again, using Angel's famous now formula, what you want over what you have. So what do we have? The 230, that represents a factor of, thank you, Tembela. There we've got the formula. Thank you very much, Tembela. So what do we want? We want the 15 factor. What do we have? We have the 115 factor. Thank you, Vuyukazi. There we go. There's the complete formula, right? And then you multiply it by the consideration. So that gives us a VAT output of 30 rands. So therefore, ladies and gentlemen, with how much are we going to credit our sales account? Thank you so much. Oh, too many. Yes, you are all spot on. You are all spot on. We're all on the same page. That is wonderful to see. Right, ladies and gentlemen. So clearly, to put this in very simple terms, the 200 rands belongs to us, and the 30 rands belongs to the revenue service. So there we've got the entry, right? So we are debiting accounts receivable or debtors with 230, crediting sales with 200, crediting VAT output with 30. So that 30 rand belongs to the revenue service. That 15 rand input we've already paid to our supplier. Our supplier would have paid that over to the revenue service. So therefore we can use that now as a credit. So when we get to the end of our VAT period, which we said last week is normally a 2-month period. In one of Dr. Smith's classes, she explains there's a category A and a category B and a category C and so forth. But the default, the normal one would be a 2-month period. So when we get to the end of that value added tax period, ladies and gentlemen, we've got to then go and close off the VAT input account as well as the VAT output account, right? So we're going to close it off. For that purpose, we create a third value-added tax account, which we call the VAT control account. The VAT control account. So, ladies and gentlemen, now you must remember, during the course of that 2 month period, during the course of the 2 month period, you would have had many acquisitions, thousands of them, and hopefully thousands of sales as well, right? So you'll have, in other words, thousands of entries of input VAT and thousands of entries of output VAT. So at the end of that period, and I'm going to come back to a little fine tuning just now, at the end of that 2 months period, you're going to add up, you're going to balance off or close off, I should say. You're going to close off your VAT output account and you're going to close off your VAT input account to the VAT control account. So, ladies and gentlemen, if you can type in for me, let's just imagine, that that was the only, or those were the only two transactions we had during the course of the 2 month period, just for illustration purposes. But we must remember we are going to add up all the transactions, right? The VAT effect. So what is the total balance? And please also say whether it's a debit or a credit. What is the total balance, debit or credit, on our VAT input account at the end of the period? What is the total balance? It is a debit. Thank you, Angel. It is a debit. And what is the total balance on it? If we add up all the figures on the VAT input at this stage, I think I said. Okay, you all typing the VAT output for me now. Okay, good, not a problem. So the total on our VAT output is 30 rands, and is that a debit or a credit? That 30 rands. That is a credit, right? Thank you, ladies and gents. And now we get to the input taxes there. There you're all saying the output tax has a credit balance, right? And the input tax, as Zintley and many others have said there, Sibusiso, has got a debit balance of 15 rands, right? So now, ladies and gentlemen, we've got to close those two accounts off to the VAT control account. So in the case of the VAT input, if it has a debit balance currently, what do we have to do to get rid of that credit of that debit balance? Debit the account again or credit the account? Credit. Thank you so much. Now we've got to credit that account, right? To get rid of the balance, we've got to credit it with a full amount on that account, which in this little simple example is 15 rands. In the case of our VAT output, it has a credit balance. So if we now want to get rid of that credit balance of 30 rands, what do we have to do with that account now? Debit it. Thank you, Tembela, and everyone else. Thank you so much. So now we have to go and debit that account with a full balance that is currently residing on that account, which is 30 rand. So, ladies and gentlemen, now we've got a journal entry that doesn't balance. We've got a VAT output that we've debited with 30 rands. We've got a VAT input that we've credited with 15 rands. To make this journal entry balance, we need a further credit of 15 rands. And where are we going to take that credit, ladies and gentlemen? To our VAT control account. So, at the end of all of these, it is almost like a reversal. Thank you, Anna. So at the end result of this little closing entry, the end result is that we are sitting with a VAT output account that has a zero balance. So we start afresh. We start from scratch at the beginning of the next value-added tax period. The VAT input tax account also now has a zero balance. So at the end of that tax period, that VAT period, it has a zero balance. We start afresh in the new VAT period, right? From scratch, from zero. Also, the effect of that is that we now have a VAT control account with a credit balance of 15 rands. Now, anyone that wants to say it, you're welcome to say it in person, or you can type it. That credit, thank you very much, that credit of 15 rands in the VAT control account, what does that represent? What does that represent? Who wants to give it a shot? Lucille? So we're saying at the end of all of that closing transaction, right? At the end of the closing transaction, we end up with that output with a zero balance. We end up with that input also with a zero balance because we're starting a fresh VAT cycle, that period. But we are left with a VAT control account with a credit balance of 15 rands. So what I'm asking here is, what does that represent? Are you just going to carry it down? Thank you, Mr. Soul. Thank you, Zinclair. You don't even need a question mark. You are correct, right? So that is the amount that you have to pay over to the revenue service. In other words, that is a sort of a creditor. Thank you, Aneswa. It's payable to SARS. Thank you, Enrique, as well. Okay, so that is the VAT payable. That's the amount that after the 2 months VAT period, when you submit your VAT 201 return, that is the amount that you must pay over. So you're going to do an electronic funds transfer to the revenue service of 15 rands. So in other words, that's the difference between your output and your input. So the value that you've added there comes down to 100 rands. You've added 100 rands worth of value within your business, which means you have to pay over 15% on that. Ladies and gentlemen, I just want to fine tune this a little bit. Let me just see. I think the only things that I've just added there, we've discussed this last week already. Standard rated supplies are at 15%, zero rated supplies such as fresh fruit and vegetables, zero rated. Exempt supplies, things like residential housing, where the supplier is not allowed to raise output tax on it, but they're also not allowed to claim back the input tax. Whereas in the case of a zero rated supply, they are allowed to claim back the input tax. Now, I just want to fine tune this argument here in two ways. Ms. Morris is actually the expert on what I'm going to be saying now. First of all, you know that we are going to be discussing from next week special journals and special ledgers. And we've just briefly mentioned in our introduction last week that you will have something called a sales journal, or accounts receivable journal is the more modern term. You might have a purchases journal, or the more modern term is an accounts payable journal, where you record all these transactions that happen on a second by second basis that are continuously occurring. So in that little in that book, that book, what we call a book of first entry, in that journal, you will normally have a column for the exclusive amount. You'll have a column for the value added tax, and you'll have another column for the total amount. So let's say this is our sales journal, ladies and gentlemen. Let's say this is our sales journal. Okay, so this means this reflects our dealings with our customers, the supplies that we have made. Right. So, ladies and gentlemen, the total of the VAT output column, the total of the column where you have recorded to all the VAT outputs that you've raised on your supplies made to your customers, to which account are you going to post that? I think it's pretty obvious, but you can still type it for me. I just want to make sure that we are on the same page. To which account are you going to post the total at the bottom of all the entries that relate to your output VAT? Somebody can type for me there. I think you're worried that it's too obvious. You cannot believe how obvious it is, so you cannot believe that your answer can be correct. Sibusisi, before we do it, before we take it to the VAT control account, where do we take it first? Like I say, I think you cannot believe how straightforward this is. You take it to the VAT output account, ladies and gentlemen. So the total of all the amounts that you've raised with regards to value added tax, you simply are going to post that to your VAT output account. I hope that makes sense. Now, what about the total of the exclusive amount, ladies and gentlemen? The total of the exclusive amount. Where are you going to post that to? Let's say you are a normal retailer, you are buying and selling goods, you're not a manufacturer or a services company. So to which account are you going to post the total of the exclusive amounts? I think again you cannot believe how straightforward it is. Keegan, thank you. Thank you, Sibusiso. Okay, to your sales account. That's the money that belongs to you as a business, right? So the VAT output, you literally, the column that says VAT output, you literally post to the VAT output general ledger account. And the total of the column that you will call sales, you will actually call that column, the heading will be sales, you will post that to your sales account. And then what about the total of the inclusive amount, ladies and gentlemen? Remember, we've got three columns here. The total of the inclusive amount. To which account are you going to, in this case, you're going to debit that account? To which, because you've already now credited sales with the exclusive amount, you've already credited the VAT output with the VAT itself, but now you've also got to debit something with the same amount. Thank you, Sibu Sisu. There we go. Thank you, Keegan. So if we are crediting it with a total, then we've also got to go and debit some account with a total. And who owes the money to us? The customers. That is the amount they owe us. They owe us the amount for the sale, which belongs to us. They also owe us the money for the value added tax, which doesn't belong to us, but which we have the duty to pay over to the revenue service. So we're almost like acting as a collecting agent for the revenue service in that case. Okay, the same, if we can just maybe look at the other side of the coin, ladies and gentlemen. If this is our purchases journal, we're going to have three columns. We're going to have three columns. We've got a VAT input, we've got a purchases column, and we've got a total, in other words, the inclusive amount. Now, if we are, doesn't matter which system we are using, if we are going to add up all the figures in the VAT input column, which account are we going to debit? If you can type for me, please. This time you can believe it's so straightforward. VAT input, thank you, Enrique. Thank you, Keegan. Thank you, Ndabeni. VAT input, so you don't even have to ask the question. That is the correct answer. So you're going to debit the VAT input account. Now, assuming that we are using a perpetual inventory system, the purchases column, which account are we going to debit? The one that excludes the VAT. The figures that are excluding VAT. Which account are we going to debit if we are using the perpetual inventory system? Inventory, ladies and gentlemen. Inventory. Thank you, Sibusiso. Inventory. Thank you, Leletu. Then we're going to debit inventory. If we are using the periodic inventory system, thank you, Angel. If we are using the periodic inventory system, which account are we then going to debit? Purchases. Thank you, Sibusiso. Then we are going to debit purchases. So now we've debited VAT input with a 15% value added tax for the factor of 15. We've debited our purchases or our inventory with a factor of 100. Now we've also got to go and credit an account. So, ladies and gentlemen, obviously we've got to credit an account with the same total as we have debited those two accounts, right? So which account are we now going to credit with the inclusive amount? The amount including the value added tax. In other words, the total consideration. Which account are we going to credit? Accounts payable. Thank you, Sibusiso. Thank you, Keegan. Thank you, Tina. Okay, you get the idea, right? So we are recording the acquisition. Thank you, Angel. We are recording the acquisition on the debit side as well as our input VAT that we can claim back. And on the credit side, we are raising the liability towards our suppliers. Okay, ladies and gents, that is really all that we need to discuss. I think you know now how value-added tax works. We've called that little folder, what is value-added tax and how does it work? So hopefully by now you know what value-added tax is and you know how it works. So now the transactions, to record the transactions are actually pretty straightforward, but now we've got to go and do some more fancy, some more complicated calculations. But just before we do that, there's another thing that I just wanted to add here. We've spoken about the books of account. Now, as you may know, most businesses nowadays will use some sort of an accounting package, a computerized accounting package to do all the recordings of their transactions. In your second year, you're going to have a subject which Mrs. Morris also presents that is called Accounting Information Systems. AIS, Accounting Information Systems, yes. So there, one of the modules that you will be doing, you will be taught how to use Sage 1 cloud accounting. That is the more modern version of Pastel Sibusiso. Pastel is still a PC-based system, but the more modern one, which is now called Sage 1 Cloud Accounting, is cloud-based, right? There are many such packages. This is probably the one that is the most popular. There's also something called QuickBooks. You probably have seen the ads on TV about QuickBooks. So there are various options. Now, ladies and gentlemen, like I said earlier, Ms. Morris is really the expert on this. But I can tell you, when you set up your accounts, initially, you will already indicate whether the suppliers from this particular supplier, whether it is standard rated or whether it is zero rated or whether it is an exempt supplier. So then when you are going to record this transaction, if you go to the module within Sage 1 Accounting or within Pastel or within QuickBooks, where you are going to record your purchase and you have set it as a standard rated supply, and obviously you would have initially said the standard rate currently prevailing is 15%. So you set up your set of electronic accounts beforehand. And then you will type in there, ladies and gentlemen, you'll type in the consideration, and this is a taxable supply. When you do this entry on Sage 1, you have the option to change it. You can, if it's normally a standard rated supply, but this one happens to be zero rated, then you can change it while you are entering this transaction. So you will there say, let's say my total consideration for the sale was 230 rands, right? You type that in, and then automatically, as if by magic, Sage 1 or Pastel or QuickBooks or there's some others. There's what's the other one I used to use many years ago? Acfin. So
there's also zero, sir. Sorry, there's
Zero.
also zero, one of the latest ones.
There we go. Then, as if by magic, thank you, Miss Morris, as if by magic, it'll show you that the sale was 200 rands and the VAT output is 30 rands. So when you save that transaction, now this all depends whether it's a real-time system or a batch processing system. We don't need to know too much about that yet. You'll be taught about that next year. Then it will automatically update your ledger accounts if it's a real-time online update, or if it's a batch update like I think the old Pastel used to have, then you'll have to run an update. You'll have to say at some period at the end of the day, update. Then it debits your accounts receivable with 230 rands. It credits your sales account with 200 rand. It credits your VAT output with 30 rand. So it adds it up at the end of the day. So as you can see, what I'm really trying to say is whether you are recording this in a physical book or whether you are recording it in electronic books, the principles are the same. The principles are the same, but the convenience that you have with an electronic system is if you enter the one amount, it can calculate the other two for you. You don't have to do that manually. Ms. Morris, am I sort of on the button there?
Yes, you are, sir.
Oh, thank you so much. I hope so. Right, ladies and gents, so next year you are going to put all of these principles into practice, not only in written form, but also in electronic form. So that is something to look forward to. It's actually a very exciting subject. I think you'll enjoy it tremendously. There I'm marketing your subject, Ms. Morris, but it truly is. It is very exciting. Okay, ladies and gents, let's just pause there for maybe half a minute or a minute before we go away from these short little notes. Then we're going to start looking at some questions. But before that, I just want to check whether you've got any questions so far. So this is now a good opportunity to raise anything that you're uncertain about. Okay, doesn't look like it. No hands are up. I don't see anything. Sir, is the bad debt a VAT input, Angel? That is a very good question. The bad debt. What what we must now here realize that if you have a bad debt, that means you've already made the sale, right? You've already made the sale. In other words, you've already debited your debtor with the full consideration. You've already credited the sale with the amount that belongs to you, even though you eventually you're not going to receive it, but you thought at the time that you're going to receive it, and you already raised the output VAT. You've already raised the output VAT. Now, ladies and gentlemen, uh, because you've already raised the output VAT maybe 2 or 3 or 4 months ago, it means you have probably already paid it over to the revenue service. But let's look at two scenarios here. Let's look at two scenarios. In the unlikely event, thanks for that question, Angel. It's a very, very good one. In the unlikely event, in the unlikely event that you haven't paid the VAT over yet, you haven't paid the VAT over yet. So let's say you're still in that same VAT period. What will you then do? You are going to debit with the amount that belonged to you, the exclusive amount, in other words, the exclusive amount. You're going to debit an account. What is the modern term for bad debts? It is credit losses, right? You remember last semester we spoke about that. So it is a bad debt, but we just nowadays with the new IFRS, and the new IFRS refers to it as debit losses. So we're going to debit losses, right? Debit losses, and we're going to credit. Which account are we going to credit? Let's see if you remember. Anyone can type that. Let's maybe use the figures we've got in front of us, right? That same cell. So that is the one that has become bad. That is the one that we are now going to suffer the credit loss on. So we are going to debit, and remember we say in this scenario, we haven't paid it over to the revenue service yet. We haven't paid it over to the revenue service yet. So we have originally debited accounts receivable. We have credited sales with 200. We have credited VAT output with 30 rands. So with how much are we now going to debit our credit losses, ladies and gentlemen? We're going to credit. Remember, we have debited accounts receivable. Which account are we now going to credit if we cannot recover that amount? Which account are we going to credit? with a full 230 rands. That gives you a hint. That gives it away. If we cannot recover the amount that is owed by the debtor, which account are we then have to go and credit? Where does that debt sit? It sits in our accounts receivable. Thank you very much, Sibusiso. It is currently, as you can see on the screen there, that 230 rands is, thank you, Anezwa. It's sitting in our accounts receivable. So now we have to go and credit that accounts receivable with 230 rands, assuming that we cannot recover any part of that debt. So with how much are we going to debit our credit losses, ladies and gentlemen? How much let's ask it this way. How much of that belongs to us? If you can type for me, how much of that total amount belongs to us? 200 rands. Thank you. You are sharp. You are quick. Exactly. So 200 rands belongs to us. That we cannot recover now. So it means we have to go and write it off. So therefore, we are going to credit accounts receivable with 230 rands. And as you also rightly says there, we are going to debit credit losses with 200 rands. But now, ladies and gentlemen, we have a Angel, accounts receivable. Okay, just remind me where we finished. Accounts receivable is the amount being owed by your customers to you. In other words, it is amounts that you are going to receive from your customers. Accounts payable is the amounts that you owe to your suppliers. Right, so accounts receivable, I'm going to receive the money. Accounts payable, I'm going to have to pay the money. Right, so accounts receivable represents your credit customers, and accounts payable represents your suppliers, your credit suppliers. Happy, Angel? Yeah, it's basically debtors control or creditors control. Your debtors, thank you, Angel. Your debtors control is your accounts receivable, and your creditors control is the same as your accounts payable. No worries. Thank you. Okay, ladies and gentlemen. So now again, we've got a situation. Our journal entry doesn't balance. So we've credited accounts receivable with 230. We've debited credit losses with 200. So we need a further debit of 30 rands. Now, if we haven't paid over the value added tax yet, which account will we then debit with the 30 rands? Again, this is more obvious than you think. Somebody actually typed earlier, it's almost like reversing. Now, here you are literally reversing something. You are truly reversing something. What are you reversing? You are reversing your output VAT. So, ladies and gentlemen, if you haven't paid it over to the revenue service yet, which account will you now go and debit with the 30 rands? Because you're not going to pay it over now to the revenue service. You haven't yet, but you're also not going to. Because that sale, you're not getting the money for the sale. So you are going to be debiting your VAT output account. Thank you, Musanda. 100% spot on. So in that case, you're going to debit your VAT output account because at the moment, that 30 rands is sitting on the credit side of your VAT output account, right? But now, because you cannot get the money from that customer, it means it will be unfair to you to still pay over value-added tax, which you are not even going to receive from your customer, right? So therefore, you are canceling that. Inati, about the VAT control. The VAT control is simply where at the end of your VAT period, it is simply the account where you close your total VAT inputs and your total VAT outputs too. You're going to close off your VAT input account, and the total of that figure, the total balance on that account will be taken to the VAT control account. The same with your VAT input. What did I say first? I can't remember now. But both of them, the VAT input as well as the VAT output, you are going to close them off to the VAT control account, and that will then represent the amount that you owe to the revenue service. Let's take that little argument further, Inati. So you're sitting in this example here with a credit balance of 15 rands on your VAT control account, which means that is what you owe to the revenue service. So before the 25th of the next month, you must now actually pay that. So when you are going to do an electronic funds transfer, how are you going to record it? You are going to credit which account? When you make the payment? Anyone can type for us there? This is the easiest answer of the day. When you make a payment, which account do you credit? No, when you make a payment, ladies and gentlemen, forget what you are paying for, just you making a payment. Bank, thank you, Enrique. Thank you, Inako. Thank you, Kobe. Thank you. Okay, so when you are making a payment, you're going to credit your bank. In this case, you've got to pay the revenue service 15 rands, right? So you're sitting with a credit balance, which is basically a creditor of yours of 15 rands. So you credit your bank account now and you debit the which account, ladies and gents? When you make the payment, now it's for the VAT. It is a sort of account payable, but we've given it a specific name, Caleb. We've given that account a very specific name. So it's not amongst your other accounts payable. Control. Thank you, Anna. Anna's got it right. I'm not going to mention if it's the names if it's not correct. So you are going to debit the, thank you, Enrique, the VAT control account, because that is where the liability sits, right? That is where the liability sits. You all happy with that? Okay. Right, and I think it was Inati. Inati, you're also now happy with how the VAT control account works. So it's basically just where you close your input and output tax accounts off to so that it reflects the liability, and then at the end of the day, you've got to clear that account when you make the payment. Now, ladies and gentlemen, where were we? We were still talking about the write-off. So we've said that if we haven't paid over the value-added tax yet, then we are simply going to credit the accounts receivable with the full amount, the full 230,000, because we cannot recover it. We're going to write it off to our credit losses account, but only the amount belonging to us of 200 rands, and we're going to cancel the VAT output. Currently, it's sitting in on the credit side of our VAT output account, but we are not going to pay it over to the revenue service because we cannot collect it from our customer. So it means we are going to debit the VAT output. Okay, so that is part of the answer. Who were at the answer? I think it was a question. I think it was Angel, if I remember correctly. But anyway, now let's assume we have already paid over the value-added tax. So in other words, the sale was done many months ago. We've already paid it over. Did you just see Lungani? Yes, you've got a hand up. Zama as well.
Yes, I have a question, sir. I wanted to ask that where do we record in the financial statement? Where do we record the value-added tax? Do we record it under creditors or?
Thank you for that question. As we've said earlier today, as well as last week, obviously in your statement of profit or loss or your statement of comprehensive income, it will be nowhere, simply because it's not a cost to the company. Neither is it an income for the company, right? But if you owe the money to the revenue service, like in this case, if at the end of the month you've got a credit balance on your VAT control account of 15 rands, then you're going to disclose it on the face of your statement of financial position under current liabilities. And next year in financial accounting, thank you, Lucille, exactly, under current liabilities. Quite correct, spot on. Next year, you'll see the way that we disclose it, we're going to disclose it as current tax payable, value added tax, right? So if we have a credit balance in our VAT control account, we're going to disclose it under our current liabilities as current tax payable, or value added tax. Angel, yes, they will. You'll see we're going to do some questions soon today. They will indicate whether it's inclusive or exclusive, right? So you will know whether it's inclusive or exclusive, and you've got to do the necessary adjustments. Just to complete that argument, ladies and gentlemen, you're welcome, Lungani. Just to complete that argument based on the question that Lungani asked, if your VAT control account for that month happens to have a debit balance, if it happens to have a debit balance, where are you going to show it in your statement of financial position then? Under which heading? Not current liabilities anymore, but current assets. Thank you, Tembela. Thank you, Lucille. Thank you, Asive. Thank you, Musanda. Then you're going, Zama, I'll be with you in a second. Just keep your hand up, please. I'll be with you just now. Keep it up, keep it up, keep it up. So, ladies and gentlemen, then it's going to be under your current assets, and then the description, as you learn in financial accounting 2 next year, your description will be current tax refundable, because the revenue service must pay you that amount back. They must refund you. Then you're going to call it current tax refundable, value added tax, right? So just be patient with me. I just want to finish that argument about the write-off, and then I'm going to listen to you. So, ladies and gentlemen, if we have already, and this was Angel's original question about 2 hours ago, I'm sorry, I'm exaggerating. So if you've already paid it over, then the situation is slightly different, ladies and gentlemen, and it is not not for accounting reasons. It is because of the way that the VAT 201 form, the return, has been designed. It has been designed in such a way that you have to disclose your capital output tax as well as your non-capital output tax at the top. Then you've got to deduct your various kinds of input taxes. And under the input taxes, they've got your normal non-capital input tax. They've got capital input tax, in other words, on non-current assets that you've acquired. And then they've got a separate block for under your input tax for bad debts. Okay, so that changes the situation a little bit. So therefore, ladies and gentlemen, in the case of where you've already paid over the output tax, then you are going to credit accounts receivable with the 230 as we've done before. You are going to debit your credit losses with the 200 Rand as we did before, but now in this case, you're not going to debit that output, you're going to debit that input. Okay, so there's a slight difference there because you've already paid it over. You've already now paid it over to the revenue service. Now you have to claim it back. So now you are going to include it amongst your input VATs. And there's actually a separate block for that on the VAT 201 return. I hope, is everybody happy with that? Do you understand how that would work? So the only difference is if you've not paid over the value added tax yet, then you can simply cancel the output tax. But if you've already paid the output tax over to the revenue service, you cannot simply go and cancel it. You now have to claim it back from the receiver of revenue or the revenue service. Therefore, you're going to debit your VAT input. I'm not sure what you want me to repeat, ladies and gentlemen. What I'm just maybe we'll just go through the whole process again. If we have a debt that we cannot recover, right, we've got to write it off. So we're going to completely cancel the whole amount that that debtor owes us, in this case 230 Rand. So we're going to credit accounts receivable with 230 Rands. We're going to debit our, we are going to do many examples, Tina, don't worry. We're going to do many examples. So you're going to debit your credit losses with 200 Rands in any situation like that. But then depending on whether you've already paid over the value added tax to the revenue service or not, that is going to make a difference to the account that you debit with regards to the value added tax itself. So if you haven't paid it over to the revenue service yet, you're going to debit the VAT output to cancel the 30 Rands. But if you've already paid over the 30 Rands to the revenue service, that means you've now got to claim it back, and therefore you're going to debit the VAT input account in order to be able to claim it back. Ladies and gentlemen, we have to move away from this now. There's been a lot of questions, very good questions, and I appreciate them. Hopefully, we've discussed all of that now. Remember, I'm going to make this recording available afterwards. So if there's something you want to listen to again, you can always do that. So now let's go to the questions that I've loaded on Blackboard for you. You probably saw in the email that we sent out yesterday, there are 2 questions that are available on Blackboard. They come from your textbook. So let's look at them. Let's look at the first one. Let me just go and see. I think it was 10.5. Just wait until you can see it on your side. And I want you to open it, or it doesn't really matter whether you open it on your side. I'm going to display the question as part of the answer in any case. So here they say question 10.5. This deals with markups, ladies and gentlemen. So that is not strange or foreign to you. You know all about that. But now we also bring value added tax into the equation. So let's read the question. Some of you might have already done that perhaps last night or early this morning. They say the table provides various amounts for cost price, selling price, both including and excluding value added tax, and the value added tax amounts itself, as well as markup percentage on cost price. Wow, that sounds complicated, but as you'll see, it is not really that complicated. You are required to calculate the amounts or percentages that belong to the letters A to P, and they say that is applicable at the rate of 15%. So all those letters A, B, C, D, E, F up until P, we have to go and calculate. All right, ladies and gentlemen. So on the left-hand side of that table, we can see we've got the selling price including VAT. Selling price including that, so that is the consideration. Then we've got the value added tax. Then we've got the selling price excluding the value added tax. We've got the cost price excluding value added tax. And we've got the markup or gross profit, right? So therefore, ladies and gentlemen, we've got to go and complete that table. Yes, Ms. Morris.
Sir, can you please just zoom the screen? The writing is a bit too small. Thank you.
Oh, let me just see. Oops, no, that wasn't what I wanted to do. Click
The
next
plus
to
sign
it.
next to it.
Yeah, that is where I wanted to click. Is that better?
Yes, it is. Thank you, sir.
Okay, excellent. Thank you, Ms. Morris. I did see your message, the private message earlier. I just didn't have the opportunity and time
No,
to actually
it's
answer.
fine. It's fine. Thank you, sir. I'm already back. Thanks.
Okay, perfect. Right, ladies and gentlemen. Now, to do this question, I guess the best way would be to start from the bottom up. In other words, to start as low as possible. Sometimes it's not going to be possible because we haven't got. We are only given the figures at the top or somewhere in the center. So we'll have our work cut out here. But I guess Angel's recipe, which, like I said, is now becoming famous, that little recipe of what you want over what you have is going to come in very handy here. Really going to come in very handy. Okay, ladies and gents, those of you who have had a look at it already, you are welcome to give us some answers. Those of you who haven't had a look at it, you can work out the answers as we go along. Okay, so let us go and have a look at the solution, and then we are going to see how we actually arrived at the various figures. Right, so we're going to tackle them one by one, one by one. So the question will again be there. I'm going to have to make it bigger, I guess. Let me just see if you can see it already. Yes, you can. Should I make this one bigger as well? Oh, there was a student who still wanted to. Is this one okay, or must I make it bigger? Must I make it bigger?
Please.
Plain bigger. Okay, I will do. I just forgot there was a student who had a hand up. I didn't ignore you. I forgot about it. I forgot about it. Who was it again? Do you still have a question that you wanted to? Yeah. Do you still have that question? Or have we answered it in the meantime? Okay, hopefully we've answered it in the meantime. Okay, ladies and gents, so let's have a look at the first one, right? What do they give us there? They give us there the cost price excluding VAT, the cost price excluding VAT, and then they give us a markup or a gross profit of 50%. So the first thing that we now have to go and calculate is what is A. In other words, what is the figure that represents the markup, right? So how are we going to do it? We see the cost price excluding value added tax, right? So the cost price is 100 Rand. Our gross profit is 50%. So therefore, what is, or the gross, sorry, the markup, I should say, I'm sorry, the markup is 50%. So therefore, what is the gross profit, ladies and gents? You can obviously type it in there, but we're already displaying it there. So you are going to take the 100 rands, the cost price, multiplied by the markup of 50%. That will then give you 50 rands. Right, so there we've got our first answer for number A. Then, ladies and gentlemen, the selling price, the selling price now, excluding the VAT, that will be our cost, the cost price plus the gross profit. That gives us 150 rands. Right, easy peasy this one so far. Okay, now we've got to go and add the value added tax, ladies and gentlemen. So this represents a factor of 100. We've got to add value added tax at 15%. So we are simply going to type in to our calculator on our computer 150 multiplied by 15%. That gives us figure number C, which is 22 Rand 50. And then figure number D will be the consideration or your selling price, including the value added tax. In other words, what you are going to mark that product when you put it on your shelf. And that will simply be the 150 rands, excluding that, plus the value added tax gives you 172 rands and 50 cents. Okay. All happy with the first one? You can just say yes or no. Yes, Inati, you can ask. Then you must just unmute, Inati. You're all happy. Thank you very much, students. That makes me happy. Inati, you must just unmute your mic. Otherwise, you must type it in the chat. What does A represent? A represents in scenario 1, it represents the gross profit on that sale, right? The 50% that they let me just go there. The 50% that they've given us there represents the markup percentage, right? So that's the markup percentage. The A in this case, or the H in that case, or the I in that case, that represents the gross profit on that particular transaction. Okay, so now let's go to scenario 2. Now it becomes a little bit more difficult, so we'll have to work our way backwards, ladies and gents. So here they give us a markup percentage of 40%, right? Markup percentage of 40%, and they give us the selling price, including the value added tax, as 402 rands 50. I'm sorry. 402 rands and 50. Now let's apply the angel principle. I think we should call it the angel principle now. Now, in order for us to calculate the value added tax, what do we want? Maybe you can type that for me. What factor do we want? Thank you, Sibusiso. You've already preempted us there. Thank you, Angel. What we want in order to get E, just to get E, ladies and gentlemen, E represents the VAT. Remember, E represents the VAT. What we have, thank you, Kolani, we have the 115, right? We have the 115. That 402 rand 50 represents a factor of 115 because it includes the tax. Thank you, Sivuyile. Yes, now we want the 15, ladies and gentlemen, right? So therefore, exactly, Mr. Sol, exactly. So now you'll have to take 15 over 115 multiplied by 402 rands 50. And how much do you get if you do that? If you can type for me, that we just make sure that our answers are correct. So 15 over 115, the angel principle, what we want over what we have, then we get 52 rand 50. Exactly. Thank you so much. All of you, Lisa Kanya. Exactly, the angel repeats the angel formula. Thank you, Leratu. Thank you, Inati, Laletu, Subiyile. Perfect. Now, ladies and gentlemen, we want to determine the value of F. So F is the selling price excluding VAT. So how are we going to calculate that? That is simply the 402 rand 50 inclusive amount less the value added tax of 52 rands 50, which then gives us 350 rands, right? So that gives us 350 rands. All happy so far? So that's how we get the 350. Now we've got to go and calculate G. What is G? G is the cost price. G is the cost price. And they also give us the markup percentage. The markup percentage is 40%. So if we are looking at F, now forget about the VAT. Forget about the VAT. We've already excluded the VAT. Remember, the VAT is now out when we are looking at the 350. Now we want to determine the cost. So if we only look at our markup, what factor does that 350 rands represent? If you can type that for me, please. A factor of how much? 140%. There we go. Thank you, Angel. Right. So that represents a factor of 140. So now what factor do we want? We want a factor of, Tembela has already given it to us there. We want a factor of 100. So therefore, we've got to take 100, what we want, over 140, what we have, multiplied by 350 rands. And I think I've seen in the chat, you've already determined that that was, where was it? 200. And thank you, Tembela. You've already determined that comes to 250 rands, right? So that is our cost price, excluding VAT. So now we can also go and calculate what is our gross profit. That is number H. So H, they require the gross profit. What is the gross profit? It is the 350 rands less the 250 rands. Alternatively, if you use the Angel formula, you could have said 40 over 140 multiplied by 350 rands. That should also give you 100 rands. Right. All happy with that scenario 2? You can just say yes or no, or give us a smiley face or a sad face. Yes, thank you, Musanda. Thank you, Lusikanya. Okay, thanks, Tina, Tembela. Okay, looks like we are all on the same page. Thank you so much, students. Now let's go to scenario 3. Scenario 3. So now we've got to go and calculate. L and K and I and J. Right, let me just scroll a little bit over. Oh, it doesn't matter. I see it's only the 4. So we can leave it there. Scenario 3. Right, so what do they give us, ladies and gentlemen? They give us there the selling price excluding value added tax. So the selling price excluding value added tax. So let's maybe first go and calculate K. So if we now want to calculate K, ladies and gentlemen, what do? We take the 364 rands excluding VAT. That is a factor of 100. Many of you already answered it there. Thank you so much. We want to add 15% to that factor of 100. So we're going to take the 364 rands multiplied by 15%. That will give us K, I should say, K. That gives us an amount of 54.60. Is that correct? Is that also what you have? Thank you for that smiley face there. That's some big smiles there. Is that also what you? Thank you, CBC. So okay, so we're getting the same figure there. Now, in order to determine L, ladies and gents, if we want to determine L, what do? We simply take that 364 rands that they've given us. We add the 54.60 that we've just calculated as K, and that gives us the inclusive amount of 418 rand and 60 cents. Right. So we've done that part. So we're done with the value added tax. Right. So we have calculated the output or input VAT, whatever this was. We've calculated the VAT. We were given the exclusive amount. We've calculated the inclusive amount. So now we can ignore the VAT. We can only focus on our basic inventory principles. So, ladies and gentlemen, they said there that our excluding selling price is 360. The cost price is 280. So in order to arrive at our gross profit, we simply can deduct the one from the other. So we can simply deduct the 280 from the 364. That will give us 84 rands. Right. Now, if we want to go and calculate what our markup is, our markup percentage, which is J, what are we going to do, ladies and gentlemen? We're going to take our gross profit. Remember, this is not a profit margin, it's a markup. We're going to take our, let me just go to the chat there, 130 less 100. 130 less 100, you can do that if you've already calculated the percentages. You're quite correct. But if you haven't calculated the percentages yet, what would you do? You would take 84 rands, divide by 364 rands. If you can type for me, what does that give you? 84 rands divided by 364 rands. How much does that give us? You can calculate that and type it for us, please, just to make sure that we're on the right track. 84 divided by 364 as a percentage. 30%. Thank you, Mr. Sol. So that is how we would have reached or arrived at the 30%. Or, ladies and gentlemen, Angel also suggested there, you could have, if you want to do more calculations, you could have calculated the 130% and the 100%, and then you could have arrived at it. But I guess the straightforward way would have been to take the 84, which we've just calculated as I, divided by the 364, which they've given to us, and that will then give us 30%. There was a hand up briefly. Yes, Inati. Inati, we can't hear you, so you'll have to switch on your mic. Oh, you've typed it. Okay. Sir, why you divide by selling price, not cost of sales? No, I'm not dividing by selling price. I'm dividing by the. Oh, sorry. I meant the cost price. I'm so sorry. I meant the cost price, ladies and gents, not the selling price. I'm so sorry. Man, this day is getting too long. I was in a Zoom meeting before the class for about 2 hours, and that tired me. So my sincere apologies, ladies and gentlemen. I didn't mean the 364. That would have been if it had been a profit margin, not the 364, but the cost price. The cost price. So the cost price, let me just see, the cost price is the 280. So my sincere and profuse apologies. I picked the wrong figure. I picked the wrong line. So you take the gross profit, because this is a markup percentage that we need to calculate. So you take the gross profit over the cost price, not the selling price. It would have been the selling price if we were to calculate the gross margin. So please accept my apologies there, ladies and gentlemen. I meant the cost. I think I actually did say the cost price, but then I indicated the wrong figure. Okay, so it is this 84 rands divided by the 280 rands. That will give us the 30%. Okay, let's go to scenario number 4. So what do they give us here? Here they give us the markup percentage, and they give us the VAT. So it doesn't really matter which one we calculate first, the M or the N. Let's maybe start with the M, because that comes before N in the alphabet, but it doesn't matter. So let's go and calculate M, which is the selling price excluding VAT, right? So again, let's use the angel formula. What do we have? That 30 rands. What do we have? The one that's going to be below the line. What do we have? What factor do we have? We have a factor of, that 30 rands represents a factor of 15. Thank you, Angel. That's the value-added tax. Yes, Ms. Sanda. It represents a factor of 15. Now, if we want to go and calculate M first, what is the factor that we want? You can type for me there. What is the factor that we want? Sibusiso, that would be if you are looking at N. If you are looking at N for Nelly. But if you are looking at M for Margaret, then we are going to be looking for a factor of 100, like Mr. Saul and a lot of others say there, right? So in the case of M for Margaret, it is a factor of 100, and in the case of N for Nelly, it is a factor of 150. 30 rands multiplied by 100 over 15. How much do we get? If you can type that for us, please. Yes. 200. Thank you, Sibusiso. So thank you, Inati. So we get 200. So that M, the M is 200. In other words, the selling price excluding the VAT. Now we can go and calculate N, but it's not really necessary. If we've calculated M and we have the VAT, then we can just add them up. So we can just take that 200 rand that you've calculated plus the 30 rands. That will give us the inclusive selling price, which is 230. Or if you want to calculate it in an alternative fashion, then you would have said 115 over 15 multiplied by 30 rands. That will also give you 230 rands, right? All happy with the VAT calculations? So to use that formula, M will represent a factor of 100. We have a factor of 15. So to calculate M, we will take 100 over 15 multiplied by 30 rands. Well, if we want to calculate N, that represents a factor of 115. So we'll take 115 divided by 15. multiplied by the 30 rands, and then we get the N for Nelly. Okay, ladies and gents, so that means we are done with the value-added tax. We've got the inclusive amount, we've got the VAT amount, we've got the exclusive amount. Now we only need to go and focus on our markups and our cost price and our gross profit, right? So we still need to go and calculate O and P. So if M is 200 rands, and they're saying that we have a markup of 25%, right? So we've got a markup of 25%, but M, you must remember, is the selling price. So therefore, ladies and gentlemen, if you can type for me the M, what factor does that represent? What factor does the M represent now? Thank you, Anna. The M, remember, that includes the gross profit, right? It includes the gross profit. Thank you, Lisikanya. Exactly. You also got it spot on. So what we have there, what we want there, is 125, right? 125. What do we have? We haven't got the M is 125, but we haven't got an O, we haven't got a P. So how are we now going to calculate the O, ladies and gentlemen? What do we want? If we want the O, the cost price, what is the factor we want? 100. Thank you, Angel. The factor that we want is 100. And the M represents a factor of 125. So therefore, to calculate the O, what do we have to do? We have to take 100, right? 100 over 125. Thank you, Sibusisu. Spot on. Multiplied by 200 rands, right? Multiplied by the 200 rands, which is the selling price excluding the value added tax. Okay, and then to calculate the P, that is very easy. So we can simply take the 200 rand that we've calculated as M. You've already now calculated O as being, what did we calculate that? As 160. So we can just deduct the one from the other, right? So the 200 less the 160 will give us the gross profit. Okay, ladies and gents, all happy with that? So these are typical calculations when it comes to your inventory, but also now we are adding the fact that we have value-added tax to boot as well. Right, ladies and gents, all happy with that one? Can we move away from that question? There's one that I still want to try and fit in if possible. Can we move away? Yes or no? Thank you, thank you, thank you. Okay, so let us move away from that one. Now we're going to look at question number 10.6. 10.6, it's quite an intricate question, so we'll have to keep our heads together. Let's just see when you see it on your side. It takes a few seconds. There we go. Now you can see it. Let me just make it larger, I guess. Okay. Question 10.6. Let's read through it and then we'll see what is required of us. So first of all, what they are saying there, ladies and gentlemen, Footlight Limes marks its goods up on cost by 50%, right? So they've got a markup on cost of 50%. So again, it's not a profit margin, it's a markup of 50%. Then they are saying the business sells an item of inventory for 3,000 rands, right? The business sells an item of inventory for 3,000 rands, which represents a figure before value-added tax. In other words, it's the exclusive figure, but after a discount of 10%. Okay, so let's maybe just repeat that last part. The 3,000 rands, which they are selling the item for, represents a figure before that, exclusive, but after a discount of 10%, right? After a discount of 10%. So, ladies and gentlemen, now we can have a look at what they are requiring of us. They say the usual normal non-discounted selling price exclusive of VAT, the VAT payable if inventory is sold in the usual normal non-discounted selling price, the cost of goods sold, actual gross profit, and then I'll give you the answer. Discuss the meaning of gross profit and net profit. Well, that's very straightforward. You all know that, but we'll give you a suggested answer there. So, ladies and gents, the first one, the usual or normal discounted selling price exclusive of VAT. In other words, the selling price if we have not discounted it. If we have not discounted it. Right. Now, how are we going to go about doing that? How are we going to go about doing that? Ladies and gents, we have to go and think. If we had not discounted it by 10%, how much would that amount have been? How much would that amount have been? Let me see what are the suggestions. Musanda, I think you've got it right. Let me just take my calculator. 3,000 multiplied by 100, divide by 90. You've got it spot on, Musanda. So how did you calculate that, or how did you get to that formula? Let us just talk through it, ladies and gentlemen. This figure, after discount, what percentage or what factor does it represent? Thank you, Lisa Kanya. You've got the answer for us there. The factor that this 3,000 rands represents, it represents a factor of 90%, right? Because we have discounted it. Thank you, Henri. 100% spot on. Because we've already included a discount, thank you, Inati, of 10%, right? So this represents a factor of 90%. What do we want to calculate? What is the factor that we want? The factor that we want is 100%. Thank you. Thank you, Lisa Kanya. You've got one too many there, one too many zero, but I know what you're saying. You're correct. All of you, thank you, Inati, etc. So, ladies and gentlemen, your formula will be what we want is 100 over what we have is a 90 multiplied by 3,000. So that gives us, if my calculator is correct, 3333,33. Right, so 3,333 rands and 33 cents. Maybe we can now go and display the solution as well. So I can already see that you get the idea. So that is hugely satisfying. Let me just make it larger again. Okay, so there we had our first calculation, the usual or normal non-discounted selling price exclusive of value-added tax. So what we did is we took the what we want, which is the factor of 100, over what we have, which is a factor of 90, multiplied by the 3,000. So that gives us 3,333 rands and 33. Let me just go back to the question. Then the second part, what is required, the VAT payable if inventory is sold at the usual or normal non-discounted price. So what they are saying, if you had sold it at 3,333 rands, what would the value added tax be on that? You simply add on the 15%, right? So you simply add on the 15%. Yes, Inati. Oops, what have I done now? Sorry, I've just gone into a different program here. Let me just get back to where we were. Inati, sorry, you were. Oh, you're just bringing your message to my attention. So discount confuses me. Let's say discount is 20%. How much will? Okay, if the discount had been 20%, Inati, then that 3,000 rands, if that had been after a discount of 20%, what factor would that 3,000 then represent? Anybody can type there. What factor would that then represent? Remember your selling price, your normal selling price we set as 100. Angel, thank you very much. That means that 3,000 would then represent not 90, not 100, but 80, right? 80. So you've got to take the 100
Yeah.
less the discount. Yes, Inati.
No, it's not Inati.
Oh.
I was asking like where the 90% comes from.
They are where the 90% comes from. Okay, they said that you have a discount. You've given a discount of 10%, right? That is part of the question, that you were given a discount of 10%. There we've got the question, right? So we are setting our full undiscounted figure as 100 minus the 10% that we have given as a discount. So that 3,000 represents a factor of 90%. So that's where it comes from. This is we set the selling price, the true undiscounted selling price. We set that as a factor of 100. We've given a discount of 10%, so that means that 3,000 rands represents now a factor of 90. Or if the discount had been 20%, then that 3,000 would have presented a factor of 80, 100 minus the 20. Or if they have given a discount of 25%, then that 3,000 rands would have represented a factor of 75. Right. So you just take the discount and you deduct it from the 100. Happy? Okay, ladies and gents. The second thing, so we've got that. The second one, so you're just going to add the 15%. So you're going to take 3,333 rands and 33 cents. Add 15% on that, gives you 500 rands. So your selling price, including that, will then be 3,833 rands and 33 cents. I know you've got a class at 1 o'clock, ladies and gentlemen. Let's just go quickly through the next two as well. Number 5, the meaning. You can, I will, the answers will be posted to Blackboard, then you can have a look. Then they want us to go and calculate the cost of the goods sold. What was the cost of the goods sold? Our normal selling price. We now know our normal selling price is 3,333. Right? Our normal selling price, 3,333. What factor does that represent? Well, they said we have a markup of 50%, right? We've got a markup on cost of 50%, right? So therefore, ladies and gentlemen, that 3,333 rands, in other words, the exclusive selling price, represents a factor of 150. So that is the one we have. So we're going to have that below the line. What is the factor that we want to now go and calculate? The cost, that is a factor of 100. So we take 100, divide by 150, 100,000, 100, divide by 150, multiplied by 3,333 rands. That then gives us 2,222 rands and 22 cents. So therefore, the cost of sales under the normal selling price will be 2,222,22. And then the normal gross profit would be the difference between those two, or 50% if you wish, which is 1,111 rands and 11 cents. And then they also want us to calculate the actual gross profit, ladies and gentlemen, the actual gross profit. So in part 4 of the question that we've been doing, question 10.6, they also require us to calculate the actual gross profit on this transaction. Now, ladies and gentlemen, we'll remember that we've calculated that the normal selling price would have been 3,333 rands and 33 cents. In part 3 of the question, we've already calculated that the cost of sales is 200 2,222 rands and 22 cents. But now the actual transaction took place at a discount of 10%. So therefore, we did not sell it at that amount, the 3333.33, but we sold it at 3,000 rands, right? So what we need to do now to calculate the gross profit, we take the actual selling price of 3,000 rands less the amount that we've already calculated as cost of sales. So we just transfer it over to our fourth calculation, and then the gross profit, that gross profit there will simply be the difference between the actual selling price of 3,000 rands, the cost of sales of 2,222 rands and 22 cents, which therefore gives us 777 rands and 78 cents. Right. So now I feel we've properly rounded the question off without being in a rush. Thank you very much.